Good afternoon. This is Tina Powell, business consultant here at Beacon Wealth Management. I want to take a minute to thank everyone for joining us for today's webinar. The topic for today's webinar is Second Quarter Market Update 2018. And during this broadcast, Beacon's CEO, Mark Germain, along with Christopher Cacchiola, Partner and Director of Wealth Management, will present their views about the markets and the most recent economic quarter. Please keep in mind this material represents an assessment of the market environment at a specific point in time, and it is not intended to be a forecast of future events or as a guarantee of future results. The information is intended for educational purposes only. This webcast is being recorded on Wednesday, August 1st at 3 p.m. Eastern Standard Time and will be shared following the broadcast via email. All participants have been placed in listen-only mode for the first part of our broadcast. Should you have any questions, please type them into the chat and save them for a latter part of the broadcast. You will have the option of asking your questions live or through chat. Please do not use your name. If you're experiencing technical difficulties, please call our office at 201-447-9500. And with that, let me turn it over to Mark Germain.
Tina, thanks. And I also want to thank everyone for tuning in. And I have a special set of thanks for what I'm going to call our production crew. So, when you watch CNBC, it's not Joe who's doing the work behind the scenes. He's got a production crew. So first, everyone, just listen to Tina Powell. She keeps us focused on every aspect of communications. And secondly, a new name as part of Beacon is Dennis Adler, our research person. Dennis came to us after a successful career as a sell-side analyst at a number of firms downtown and is very, very instrumental in many of the slides that you're going to be seeing today. So obviously, we take a look not only at the second quarter, but reminded of the first quarter, where the general markets really didn't produce much on the positive return side in either the equity market or the bond market, leaving only some of the less obvious markets like real estate, which we're particularly fond of, and bank loans to produce the positive returns. Second quarter had some sectors that were doing better, truly did produce strong positive returns, and quite a few with strong negative returns. So kind of a quick take a look at a subset, the first half and the second quarter. So you can see two columns, year-to-date returns and second quarter returns. And you find most of what affected the whole year really kind of happened as we take a look at the second quarter, because that's where the biggest changes were going on. As we look at the Dow, year to date at the end of June, this is June 29th, it was below even. It'd gone down about 0.73. The S&P was about 2.65. The NASDAQ, kind of the small cap tech heavy, was 9.38. And then, of course, you look at emerging markets and the Europeans, and they were down. Even in the cash market, U.S. government T-bills for the entire quarter only returned 0.75%. High yield junk was up, but barely. And then U.S. government and high quality corporates were actually down on a year to date and a quarter basis. So bonds took a little bit of a hit. It was a quarter and a year where U.S. equities outperformed many of the world markets. And for the quarter, the S&P, as we talked about, we take a look at the returns up above, actually did better than 3.4. European and the emerging markets were down. All of you are wondering, and the big question always is, well, what does this mean for me? Yes, that's the big picture, and that's what's going on. I don't have the S&P as a holding in my portfolio. What's that really mean for me? And in a few minutes, Chris Cacchiola is really going to talk about what's happening to the Beacon portfolios, what's ahead. In fact, emerging market stocks overall, if you kind of take a look, we're going to take a look at the Shanghai index, and you take a look at this thing, and it's kind of dropped precipitously. This is not a Trump event, all right? In fact, the emerging market stocks overall have had a bit of a poor quarter, down 7.8%. By mid-June, emerging stock market and stock mutual funds had seen 8 straight weeks of outflows. Good sign. Probably time to actually start to think about buying some of these things as they bottom and people just keep taking all of their money out. So part of Beacon's role is to get a handle early enough, not instantaneously, not before things happen, but early enough on the direction. As we did, we lowered our emerging market exposure and increased the U.S. So also, as I said, this is not just a political happening in China. They kind of had a double whammy where the currency was down as well as the market was down. And if you look at the overall ADPA index, okay, had been moving along, and then in the quarter it actually dipped down. Among the U.S. equity markets, it's very, very clear distinction between sectors and between styles. So sectors, there's 10 sectors. You can take a look at industrials, you can take a look at financials, technology, et cetera, and we're going to show you those sectors. And so those 10 sectors, you can see that the returns went from a high, and when we look at the FANG stocks, that's not actually a sector, but we look at energy was up 13.5 in the second quarter, and we go all the way to the top and we look at industrials were down 3.2%. That's literally a 17% differential between the two of them. So there clearly is now separation in what's going to happen, where the investments actually should start to be. And clear as we look ahead, small cap over large, U.S. over foreign, developed markets over emerging, tech and energy were in, industrials and financials were out, but we didn't reduce our financials position. Cash did better than most of the subsets of the bond market. So the markets are indicating very obvious impact of the U.S. kind of taking charge of changing the international trade policies. We find the current administration trying to change trade policies that were negatively affecting the U.S. There's weakness in many global stock markets because of the threat or actual imposition of tariffs. And the uncertainty of an impending trade war has hurt some of the big U.S. national corporations, which earn a lot of their money overseas. Can't tell it by the early news in earnings reports at the end of the second quarter, which generally are coming in favorable. So in contrast, smaller companies, mostly here, they're different. And their smaller companies are mostly domestic. They, like the larger companies, are benefiting from the tax cuts, but oftentimes appear as shielded from the trade concerns. Hence, they're doing a little bit better. So they're doing just fine in this market. Investors in tech appear less concerned about tariff battles, which are mainly focused on manufacturing rather than the actual service sectors of the economy. And we talked about energy already benefiting from what's going on. Oil prices have risen almost 23% this year. Overall, this is the thing to remember. We've been saying this for the last 2 years. Overall, number one, the U.S. economy is in good shape, especially given the stimulus of the tax cuts, which has given kind of this rise in confidence to small business. Number two, this keeps this tailwind behind the U.S. stocks, which means even with all of the bad press, all of the kind of tariff war concept and everything else, there still is a tailwind behind. And first quarter earnings were stellar. And as I said, so far, the second quarter earnings tend to look very good. Third, we seem to be safe from recession, at least for the rest of this year and perhaps well into 2019. Economists who look at recession indicators are seeing very, very little, if anything, to indicate trouble right now. And some of the questions that come up from clients are, well, interest rates are doing this, and if the yield curve flattens, aren't we going to have inflation, and aren't we going to then have a recession? And very, very little indicating that that's happening. And, there was a time 10 years ago, 8 years ago, where we'd say cash is king, but for the last few years, cash was trash. And the last trend of cash is actually outperforming many of the bond positions. It indicates, and Tina, this is your namesake, TINA, stands for there is no alternative. The idea is that interest rates paid on the money market funds had been so low, everybody took risk, and they went out and did the risk. But if we look at the cash is no longer trash, you see that the yield has actually started to climb on the money markets. So from an outlook perspective, will the trend toward U.S. assets and against foreign-related assets continues? Possibly, as long as trade fears remain elevated. So it's kind of an emotional thing. It's not really fundamental, but watch for some bottom fishing opportunities, especially reemerging, especially into emerging markets. Moreover, the U.S. has been kind of the more dominant stock market for the first half of the year. Be careful as we approach the midterm elections, though. We don't really think the midterm elections, if they go the wrong way, nothing will get done in the next year and a half. There has been and will continue to be this America First, U.S.-centric stance at the administration. Tax cuts, we love them. We think that they've helped, but they're very, very complicated, and you need to get some tax professional to help you with what's going to happen to you with the new tax ones. And we are doing tax reviews on a complimentary basis for all of our clients. And is trouble brewing down the line? Two areas to take a look at, and we're going to have more on this. We're not going to talk about it today, but the corporate debt, less money globally. Bank of England mentioned last month that they're concerned about growing worldwide debt. We're going to do some more research on that. We actually have a slide that shows what's happening on the non-financial corporate debt as a share of profits, that it's actually going up as a share of profits. So this debt buildup is a little bit of a longer term risk. Shorter term, we're experiencing kind of slow pullbacks in the markets. There's seemingly some unrelated events going on where some of the emerging markets saw their currencies and their equity markets crater. They seem to be unrelated, and could they accumulate to something bigger? It's no coincidence, but the result of central banks around the world, especially the U.S. Fed, pulling back. They're no longer providing the liquidity to the markets that they did in the past. That's changing. And it appears that there's less cash on the sidelines available to buy during the dips. So that's what's going on in the general market. Some of you may have some specific questions about that. We clearly are ready to answer those. But before we get into Q&A and before we get to what's going on at Beacon, I'd like Christopher Cacchiola to take over and really talk about the Beacon portfolios, what's going on, what we see ahead. Thanks, Chris.
Thanks, Mark. So as you mentioned, coming off a touch-and-go first quarter, markets began to pick up a bit more momentum in the second quarter with the S&P up nearly 3.5%. The volatility, however, stayed with us throughout the second quarter as concerns around some of that trade protectionism and growth outside the U.S. began to simmer. The U.S. economy, however, did ease many of those fears, and it was clearly hitting its stride heading into the summer and pulling away from the rest of the world, boosted mainly by those tax cuts and fiscal stimulus. In particular, the tax cut does appear to be stimulating stronger demand growth here in the U.S. And while second quarter real U.S. GDP growth was a little weaker than some of the big expectations from many of the economists out there, it still showed an acceleration in year-over-year growth to 2.8% on its way to 3%. That being said, here at Beacon, we have mentioned on previous calls, and on this one in particular, we are seeing signs of the economic data, which we follow very closely, beginning to peak and signs of that beginning to emerge. And longer term, there are already some signs of weakness in the traditionally cyclical sectors of housing and autos here in the U.S. as well. So while the U.S. economy should maintain a close to 3% year-over-year growth rate for the next few quarters, fading fiscal and tax stimulus could bring that back to 2% or below heading into the second half of 2019. Elsewhere, the decoupling of global growth around the world is of concern for Beacon as well, as we are seeing pockets of the world begin to decelerate growth-wise. And we believe it has begun to materialize in the performance of some of those international stock indexes, which Mark mentioned earlier, in particular around China and the pressures they are feeling from the trade tariffs being put on them by the U.S. So what does it mean for our investors and Beacon portfolios? None of the above is cause for panic or real concern short term, and investors should remain invested. However, having much less conviction in any particular sector going forward is important with much smaller allocation tilts. On our last call, we did discuss Beacon's focus on growth in cyclical stocks, mainly in technology, financials, and industrials, which continues to be the case. We also remain overweight small cap stocks and have been there over the last 24 months. However, with signs that growth both globally and here in the U.S. may be slowing, as mentioned previously, we expect to pare back that exposure over the coming weeks, reallocating away from that overweight as valuation and prices of small cap stocks have simply caught up. Small cap stocks still provide for opportunity, but much less so versus 24 months ago, with them nearly doubling the S&P 500 return in 2018. Inflation assets also remain a key component to any portfolio going forward, in our opinion, and current portfolios do have allocations to precious metals, being both gold and silver, as potential hedges against rising inflation. We also have exposure to agricultural commodity stocks and energy, both outperformers so far in 2018. We are also keeping a close eye on real estate and telecom stocks heading into the fall, both being opportunistic in our eyes, as they have not participated in the market rally over the last 2 years relative to other sectors. Both real estate and telecom historically have also been valuable portfolio components during inflationary periods, and we believe that will be the case at this stage in the cycle as well. So while telecom and real estate look to be potential new additions, energy, which has been a winner so far in 2018 for investors and an overweight for Beacon portfolios, may have a tougher time moving forward as the U.S. dollar strength, in our opinion, poses a real challenge to oil prices going any higher or substantially higher from here on out. We will continue to watch this closely in deciding energy allocations for the remainder of the year. So over the last 24 months, portfolios have remained nearly fully invested. Yet as we enter the third quarter for the first time in quite a while, the fundamentals have begun to shift ever so slightly towards a less favorable story going forward. As such, portfolios will begin to reflect this shift in risk reward for our investors as we continue to pursue opportunities, but first and foremost, focus on protecting principal.
So now we are going to unmute the broadcast to give everyone an opportunity to ask their question live. And after that, after we have the questions, then I'll discuss a little bit of the Beacon happenings. And if I may say that there is also a question that came directly from our listeners out there, and that is that today the Federal Reserve announced that they would hold interest rates steady, yet they signaled that a rate hike is coming soon. What is your view on when that might happen and how that might affect your investment strategy? I'll open it up to either one of you to take that question.
Thanks, Tina, and thanks for the question. I think what's really important to remember. Are we all right?
Yeah.
Okay, so
should be unmuted.
Okay. So what's really important to remember is we've been saying all along that the Fed is going to continue to increase interest rates on a slow basis. So the fact that they just didn't raise it now in this last meeting is no indication that they're not going to do it going forward. We believe they will do it again, possibly twice this year, but definitely at least once between September and December. Okay? What's the effect? We think it has little to any effect whatsoever on what's going on. You want to add to that?
Yeah, the one thing I would add is we've discussed in the past, we watched the Fed rate hikes very closely, but also probably more concerning or something we're focused more on is the ECB in Japan in particular. They are still doing monetary easing, and in our opinion, it's distorting the bond markets, not only here in the U.S. but globally. And we're getting closer and closer to a point where they may begin to shift towards tightening or a different form of tightening, similar to the U.S. And in our opinion, that is more concerning over the medium long term. That when that happens, it may have a real effect on treasury markets and bond markets overall.
Question number 2. Please describe non-financial corporate debt.
So when we think of financial debt, you're thinking about bank debt, insurance company debt, et cetera. So when you look at all of the other corporate debt, manufacturing, service businesses, et cetera, it's debt of those companies. That's the difference.
Great. Are there any more questions? Everyone's been unmuted. If you do have a question, please let us know now, but do not give us your name.
Right. No more?
Okay, so if there aren't any more questions, I will just wrap it up with a little bit of what's happening here at Beacon as far as the Beacon happenings. And you should know that every month Beacon records a live video on Facebook dealing with an important topic or theme whereby Mark is the speaker and I am the interviewer. In July, the theme was inflation risk, and in June, the theme was SALT, state and local taxes geared around tax reform. You don't need Facebook to watch these videos, only if you want to watch them live. But they are recorded and posted to our website and YouTube channel, which is youtube.com/BeaconWealthNJ. Finally, our next event will be a Beacon Breakfast on Thursday, August 16th at 8 a.m. The topic will be tax reform. Please register with Reshmi via email, reshmee@bwmllc.com, or by telephone at 201-447-9500. So that concludes our broadcast. Thank you so much for tuning in, and please feel free to send us your questions, comments, and even suggestions to our office, either by phone or by email. I can always be reached, tina@bwmllc.com. Again, thank you for the courtesy of your time and attention. Everyone have a great day.